Oh, right. Today is Tuesday, December 6th. This is a recap for the stock market activities today. Now, folks, I got a good one for you tonight. And look, let's start by this. There has been a lot of criticism against this channel. Hey, Maverick, your videos are too long. Nobody can watch. Are you crazy? Are you out of your mind? So I say, I've listened to your criticism and I'm responding right now. So I'm going to make this video as short as I can. How about one of these shorts? You know, a TikTok kind of video. So here's the summary of the action today. I looked at the market and I looked at the charts and I think the market can go up or down, but if I had to lay a bet, I would say it's going to stay flat. Okay, that's tonight's show. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Just kidding. Although it's going to be shorter than usual because I'm responding to your complaints. The customer is always right. But I have few stories to talk about in tonight's program. And the most important story today is what's going on in Arizona. We have TSMC, a Taiwanese chip company, that is now announcing the opening of a semiconductor plant in Arizona. And the initial investment supposed to be $20 billion, then it went to 30, then 40, then 50 gazillion trillion dollars. And I say, look, the public is pretty much propagandized at this point. You guys are going to believe whatever they tell you. You're going to look at this and say, oh, look at that, Taiwan is investing in our country. American manufacturing is making a comeback, I guess. Meanwhile, I'm looking at this as another money laundering operation. I mean, haven't we learned anything from the Wisconsin Foxconn plant in the previous administration and the fat cats who got rich from that deal, all the money laundering that took place back then? And my bet is this is yet another money laundering scheme. And I know what you're going to say. You're going to say, hey, Maverick, what's up with the tinfoil hats? Well, I lost my Santa hat, so I only got the tinfoil one. I have to put it on. I mean, really? Taiwan is investing 40, 50 gazillion trillion dollars to build a plant that produces semiconductors in Arizona? You know how much water these semiconductor factories use? And they're going to build one, the largest one by far, in the middle of a state that is running out of water? I say, who is the big guy, quote unquote, who's going to get rich from all of this? Who are the fat cats? We're going to get rich from all of this. And what I'm saying here is Taiwan is under threat. It could be invaded by China next year, 2024, 2025. It's going to happen at some point. And they want to buy a few U.S. politicians. They want to grease up the government a little bit. So if anything happens to Taiwan, your beloved politicians who got greased up are going to start World War III and fight China. You think I'm making this up, right? Well, take a listen.
You didn't want to get involved in the Ukraine conflict militarily for obvious reasons. Are you willing to get involved militarily to defend Taiwan if it comes to that?
Yes.
You are.
That's the commitment we made. That's the commitment we made. We are not, look.
But let's put the tinfoil hats aside and assume that this deal is for real. Are we going to have a $40-50 billion semiconductor manufacturing factory here in the United States? And all of these companies, instead of importing chips or buying chips or manufacturing chips in China and Taiwan, they're going to do it here in the United States. You got the iMob boss, Tim Cook, who says that Apple will use the chips from the new Arizona factory, which is, by the way, supposed to open in 2026. But don't be surprised if 2026 becomes 2030, and then whoops, the company's facing some troubles and the plans is scrapped. But the fat cats who got the money laundering cash, mission accomplished. Anyways, let's assume that this is for real. What are the implications of all of this? Think about it. Think about what you think about.
Think about what you'd think about.
When you have American companies now manufacturing chips here in the United States, paying American wages, not the Chinese slave wages, what does that mean? Chips are going to cost more. This is inflationary, and this is going to be with us for a long time. There is no escape here. The chips are going to cost more, meaning everything you use, appliances, computers, cameras, everything, is going to cost more. If indeed this is the plan, and this factory aside, at the end of the day, it is a national security issue. You have to manufacture chips in your own country. Especially here, we can no longer rely on China or Taiwan anymore. We have to manufacture chips here in the US because all of these chips go in the military and the equipments. You know the story. Furthermore, when we talk about chip companies and chip stocks, remember, chip stocks are the growth poster boy in the 2010s. These stocks shot up significantly higher. You put your blindfold on, you buy any chip stock, and you're going to score a lot of cash. But if these companies are going to manufacture chips here in the US with the costs that they have to pay for labor, for materials, for regulations, for taxes, the margins of these companies are going to go down. So the era of chip stocks being growth stocks, that era is over now. So that is the inflation part. You're going to have companies raising prices because the chips are going to cost more. And this is not just a 2022 story. Or 2023. This is the future. This is how it's going to happen. And this is inflationary. So when we talk about the tailwinds for inflation being intact, we're talking about a multi-years, perhaps multi-decades inflationary force that is still going to be with us. And if you think the Fed raising rates to a pathetic 4% will do the job in tackling inflation down, you better wake up now. And along with the inflationary force, we have a recessionary force that is creeping in the economy and in the market, and you see it every single day. And the combination of higher inflation and a recession force equals stagflation. And this stagflationary force is going to last for years to come. And the Fed at some point is going to realize to get rid of this inflationary force within stagflation, they're going to have to create a depression. And at that point, is it going to be really worth it? Or are we going to live with higher inflation for a long time? I think you know the answer. But once the Fed gets to that conclusion, it's going to be a long time from now, and it's going to be after a lot of damage already took place in the economy. And here are just few examples of the recession force from today's news alone. You got Goldman Sachs. The CEO came out and said, hey, we might have to lay out some folks. Or we might have to cut some salaries too. Not his salary, but you know, the junior bankers. They were already treated like crap in Goldman Sachs, and now they're about to get a pay cut. This is the only way they can keep their jobs. And then he got from the Landromat, Jamie Dimon. He came out today and said that the consumer is exhausting their savings. The consumer is racking up credit card debt like never before. It's absolute insanity. What's going to happen is a recession because the consumer is going to run out of spending reserves. But Jamie Dimon says it could be a mild or a hard recession. And I say, which one is it? Because it makes a lot of difference, doesn't it? If it's mild or a hard recession. But anyways, Mr. Hurricane aside, listen to this headline. Hit by high inflation, more people turn to GoFundMe to pay for gasoline, groceries, and baby formula. That's the booming economy, right? Or is it the kabooming economy? Folks are begging just to live. To pay for gas, to pay for rent, to pay for baby formula. You see what's going on here? This is unsustainable. We can no longer keep this. We need a recession. Otherwise, this is going to be an economic disaster for many years to come. An economic disaster that will destroy an entire generation. If you thought the millennials had it bad, wait till you see the Gen Zers receiving the short end of the stick. Another recessionary news, Walmart CEO says stores will close if theft at retailer doesn't slow down. We talked about organized crime wrecking Target, for example, and now we have Walmart. And if the crime continues, they have to shut down stores, meaning laying off employees. That's recessionary. And then you got Las Vegas, and the headline reads, fewer tourists and less spending in Las Vegas as inflation takes its toll. And I say it just came back from Vegas, and the town was packed. So I don't know what they're talking about here. Maybe I caught Las Vegas in a good week. I'm not sure. But if this is for real, that's recessionary. That means that the consumer doesn't have enough money, spare cash, to do travel and leisure. And here's another recessionary force. The headline reads, people still afraid of catching the thing are costing the U.S. economy billions of dollars. These are folks traumatized by the thing. You got a lot of seniors still traumatized, still staying at home. You have a lot of folks who are still afraid of the thing. They still wear masks while driving in the car alone. You have a lot of businesses who say no mask, no service. You're not getting in. A lot of consumers say no thanks. We're not coming in. To begin with, that's recessionary. And of course, the media, the government, they made people afraid of the thing, terrified. They told people you're gonna die. That's of course when it was convenient for them. Now all of a sudden, hey, the thing is over. Please go out and spend. Otherwise, the economy might fall apart. Well, good luck, because a lot of folks are traumatized right now. A lot of folks still live in fear. Thank you to the propaganda and the fear campaign. And the other story that I want to talk about briefly, but I'm going to talk about it in details in not the next video, but maybe the one after that, because it deserves a lot of attention. And this story is about Blackstone. Something big is happening in Blackstone. Something is about to collapse. I've been short the name, and I dealt with these people back when I used to work in Las Vegas. In the restructuring, in the aftermath of the great financial crisis, Vegas had to sell a lot of properties to companies like Blackstone. And these people of Blackstone took a lot of risk along with Douche Bank, by the way, and they did not care. And now with interest rates moving higher, there is a reckoning happening in Blackstone, and something is going to blow up. And once it does, it's going to be contagious. I mean, how many of these blow-ups can the economy and the market handle? We talked about Archegos. Okay, that was a safe one. It blew up, nothing happened. Then we got FTX, and then we got Credit Suisse. And Credit Suisse got bailed out by the Saudis now. Next, Blackstone. And after that, what? BlackRock? How much more can the market handle? How much more can the economy handle? Because you heard Jerome Powell, and you're seeing the evidence right before your eyes. Inflation is not going anywhere. It is here to stay. And it's going to take the Fed extreme measures to take inflation down. And these extreme measures of raising interest rates significantly higher will at least blow up a portion of Blackstone. And then what? Something to keep in mind. Again, we'll talk about Blackstone in details in an upcoming video. But for now, we'll keep it short and sweet and move on to the stock market coverage today. And we begin with the closing of the indices. And here we go. The Dow Industrial Average down by 350.76 points, or a decline of 1.03%. The Nasdaq down big by 225.05 points, or a decline of 2%. The S&P 500 in the red by 57.58 points, or a decline of 1.44%. When it comes to the sector's performance today, down across the board with exception of utilities, capturing the gold, the silver, and the bronze, because utilities was the only sector closing in the green. Yet again, a recession theme. The ultra-defensive utilities leading the pack, and the expansionary, inflationary, the offensive theme of communication services, technology, energy, cyclicals, all of these sectors are lagging today. And they've been lagging for a while now. When it comes to the advance to decline ratios, NYSE 25% advancing versus 74% declining. The Nasdaq 25% advancing versus 73% declining. On to commodities, and folks, I think we've seen enough. When we talk about the end of the energy trade, it will happen because the stock market and the economy is shifting into the recession theme. The evidence is piling up. Despite all of these good tailwinds, energy continues to slide big. How much more do we need to see? I'm not saying I'm shorting energy right now. I'm saying that my sentiment is shifting dramatically, shall we say drastically, from being hyper bullish energy to neutral / slightly bearish. I continue to hold my energy positions, but I'm still hedged, big time. Am I going to recommend for anybody to buy energy right now? I'm not going to say that. I can't say that. When we see this negative action despite all of the tailwinds, when we see severe technical damage, I can't say in good faith that you can buy the dip in energy right now. Now, can I say you can short energy? You got the green light to short energy. I'm not ready to say that yet. Few things need to happen, and they're already kind of happening before we say, okay, let's go short energy. The party's over. Here comes the recession. Look at the action today. The WTI down over 3.25%. Brent down almost 3.75%. Gasoline RBOB down over 2.25%. Heating oil down almost 3%. Nat gas is down 3.5%. Again, despite all of the tailwinds, OPEC Plus, we haven't seen the reaction by Russia yet. That could be the wild card here, but we talked about China reopening. That didn't do anything at all. We're seeing oil down. Very negative reaction by the energy market to all of these tailwinds. And this is not a good look for now. When it comes to softs, lumber bouncing higher and scoring gains of over 6%. And then we have OJ also rebounding with gains of a little over 1.5%. And we have more modest gains for cotton, cocoa, and coffee futures. Meanwhile, the laggard of the day, sugar futures, down about 1%. Now, the dollar was slightly up today. And we know metals are really sensitive to the dollar. We're seeing some mixed reaction here. The precious metals, gold and silver, are pretty much muted, be it gold in the green and silver in the red. But platinum down a little over 1%. Likewise, palladium futures down a little over 0.5 percentage point. On the other hand, copper managed to eke some gains here, worth about 0.75%. So mixed signals. We're not getting a confirmation from metals that the dollar indeed is in a rebound rally. We'll talk about that a little more when we talk about charts, but we will look at meats, massacre across the board. You got lean hogs futures down over 4%, both live and feeder cattle futures closing in the red for the day, with live cattle futures down almost 1.5%, feeder cattle futures down almost 1.25%. When it comes to grains futures, down for the most part, with exception of soybean meal futures, which managed to score gains worth about 4% for the day. Likewise, soybeans futures managed to score gains of a little over 1.25%. Moving on to the big casino, the options market, what do we see here? The volume went down from last week, no support at all, so we're seeing equities down. With that being said, calls are outweighing puts, at least for now, but the volume is not that significant at all. Regardless, the hottest table by far was Tesla at around 1.6 million contracts traded today. About 56% of those were calls. Apple at number 2 with around 1 million contracts traded today. About 50% of those were calls. Amazon at number 3 with around 900,000 contracts. About 60% of those were calls. And notice that the IV rank is rising a little higher. The volatility is moving higher. Why? Because the VIX is moving higher. In other words, the premiums for options are getting more expensive. When we talk about the unusual activities that took place in the options market today, we start with the ticker SPY for the S&P 500. Somebody's bidding for more downside here for the S&P. They bought the 355 puts for the expiration date January 13th, with expectations that the name could move down and lose more than 10% of its value by then. They paid around $1.75 a piece to enter this trade, all in all spending around $1.4 million. And then we got a trade for the XLE, the energy ETF, and while we have all of this negativity for energy, somebody sees a dip buying opportunity and they bought the 94 calls for the expiration date February 17th with expectations that the XLE could rebound and gain more than 10% by then. They paid around $2 a piece to enter this trade, all in all spending around $1.5 million. What about the IWM for the Russell 2000? Somebody's bidding against the name here, seeing more losses to come, and they bought the 156 puts for the expiration date February 17th with expectations that the IWM could move down and lose more than 13% of its value by then. They paid around $1.70 a piece to enter this trade, all in all spending around $850,000. And here it is. BX, Blackstone, this baby is about to blow, and we continue to see the bets against Blackstone accumulating, and that pressure alone will produce a reverse gamma and crush the name. Somebody bought the $60 puts for the expiration date February 17th, with expectations that Blackstone could lose more than 24% of its value by then. They paid around $1.65 a piece to enter this trade, all in all spending around $750,000. And then what about the ticker NFLX Netflix? The name has been riding high since the bottom, but it is the time to short right now. It is way overbought. The rally is overdone. And somebody bought the 280 puts for the expiration date December 23rd with expectations that Netflix could lose more than 8% of its value by then. They paid around $3.70 a piece to enter this trade, all in all spending around $1.3 million. And lastly, what about the ticker SMCI? This is a company called Super Microchips Computers, whatever. It was involved in a big scandal a few years ago. It is an outperformer year to date, but I wouldn't bet even your money on it. But since we're talking about chips and all of these factories and the money laundering, the name is blasting higher, and somebody's bidding for more gains to come. They bought the 95 calls for the expiration date February 17th, with expectations that the name could move higher and score gains of more than 10% by then, and they paid around $6.50 a piece to enter this trade, all in all spending around $2.6 million. On to the heat map. What do we see here? A bloodbath across the board, and you can see the big caps melting down. Apple down over 2.5%, Microsoft down 2%, so is Google, Amazon down over 3%, Meta down over 6.5%, Disney's melting down, the chips are melting down, the banks are melting down, Bank of America down by about 4.25%. So we hear these analysts who come on TV and say, oh, financials are safe because financials are hedged or whatever. Fill in the blank reason. Well, if we have a recession in the economy, banks is the last place to be. We got Goldman Sachs down, Morgan Stanley down, they're laying off about 2% of their employees, Morgan Stanley. And by the way, there was a hilarious interview in CNBC where the lady was interviewing somebody from Morgan Stanley. And as she finished the interview, the breaking news hit that Morgan Stanley is about to get rid of 2% of their employees. But again, back to the heat map, we see even industrials are down. Boeing, that's down. It was an outperformer, now it's going down again. The cyclicals are down, energy down, metals down. What is outperforming? Utilities. And there is relative outperformance from the defensives, from healthcare, the big pharma names, the insurance names, UNH, for example. And all of this is part of the recession theme. So we can deny and say, hey, the soft landing is coming, or we have peak inflation in the economy. But at this point, who cares? Who cares? If inflation is going down, it's going down for the wrong reasons. And among these wrong reasons is the recession. More on that by the end of the charts analysis segment. And before we move on to the heat map for the ETFs, would you like to hear a horror story? I know you guys love this segment, so let's do it. And this time around, we're talking about Carnival Cruises, a company that's, by the way, going to zero, bankruptcy. And the headline reads, a man who fell off a cruise ship in the middle of the night said he survived by treading water for 20 hours, eating bamboo, and fighting off jellyfish in shark-infested waters. If it was me, I'll just give up right away. I'll look down at the sharks and say, make it quick, okay? And take it easy on the butt cheeks. Anyhow, in an exclusive interview with ABC's Good Morning America, passenger James Michael Grimes said he had a couple of drinks on the Carnival Valor on November 23rd, the night before Thanksgiving. He was not drunk, believe him, but he doesn't remember what happened next. I guess the spirits pushed him off the deck. But anyways, the next 20 hours of his life ended up being a fight for survival, he said. I came to when I was in the water with no boat in sight, Grimes told ABC. The cruise was heading from New Orleans to Cozumel, a Mexican island in the Caribbean, traveling through the Gulf of Mexico. For the next almost 20 hours, Grimes described how he trod water and fought for his life, encountering jellyfish, these are nasty mother, and another unidentified sea creature with a fin. Whoops, it came up to me really quick, and I went under, and I could see it, and it was not a shark. I don't believe it, Grimes said, but it had more like a flat mouth, and it came up to me and bumped on one of my legs, and I kicked it with the other. It scared me, not knowing what it was. All I could see was a fin. And by the way, it was mushrooms. But anyways, as night struck and Grimes waited for rescue, he said that he had to eat objects floating by to sustain his energy, including plank of bamboo. Okay, this guy's making this shit up. Anyways, it gave some type of a flavor in my mouth other than salt water, Grimes told ABC. I was never accepting that this is it. This is going to be the end of my life. And I say, you know what? That's just another reason to short Carnival Cruises, isn't it? Anyways, moving on to the heat map for the ETFs, bloodbath across the board. But what are the outperformers? The answer is, once again, the XLU utilities. You see gold kind of holding ground, not actual gold, but GDX gold miners. But besides that, ugly day across the board. The short covering in Chinese ETFs continues to go on, but that's going to stop at some point. And I say maybe you should start thinking about buying puts in the FXI. Maybe. Do your own homework. I'm not going to make the trade for you. We also have the EWZ blasting higher and scoring gains of 1.5%, but this was a laggard for a long time, so it's just playing catch up here. I would not buy it at all. Moving on to charts, and we begin with the SPY, the S&P 500 30-minute chart. What do we see here? We did not even get a gap or an oversold reaction in the morning. It was open and flushed down all the way till the end of the day. The selling force was supreme. Nobody wants to buy. Nobody's buying call options, and this is what happens. And of course, the moment the chart lost 398, that produced a lot of selling. And at the end of the day, the chart lost 393.16 as support, but by the end of the day, it managed to recapture that as support. And now, when we look at the RSI, it is severely oversold. So we are due for an oversold pop. Is it going to last? I doubt it. But we're due for a pop, an oversold pop. It could be a gap and crap. It could be a little bit of an attempt to recapture 398. But folks, we do have a reversal here. You can look at the chart and you see the Powell pump. That's gone now. That is a reversal. And to look at that clearly, look at the daily chart for the continuous contract for the S&P 500. Look at this. What used to be support, now resistance. 3,960 used to be support. Now it's resistance. Can we get a pop above it in an oversold reaction? The answer is yes. But can we hold above it? I doubt it. The reversal in the SPY already happened. Look at the MACD indicator. We have a confirmation. We need more confirmations to come. But I think the writing is in the wall. We're done here. Now, does that mean that we're going to flush down all the way back to the June bottom? Not so fast, because we have the PPI coming. We have the CPI. And that could give the bulls some hope. More on that by the end of the video. But look at the volume. It's moving higher again on the selling side. The RSI is moving down again. What more do you need to see? Here's the SPX, the cash index for the S&P 500. We have a rejection now. But do we have a reversal in the SPX? You can say that if you want, but I'm being conservative. And my number that I talked about last night hasn't been taken out yet. So we're waiting for that. You can be more conservative and say I'm waiting for the weekly closing. I get all of that. But there are a lot of traders who've seen enough and they're ready to go short right now. That entails some risk because the reversal is not locked in. It would be locked in if the SPX closes below my number that I talked about last night. And we're talking about a weekly closing and we see a reversal in the MACD indicator. But that is the super conservative take. If you are a really disciplined trader, a lot of folks, this is the risk business after all, a lot of folks would take the risk right now and say, I've seen enough, down we go. What about the Qs? 30 minutes chart. Again, look at this massive flush down. We did not even get a reaction, an oversold reaction yesterday. Nothing. Immediate flush down, and once the support of 284 was taken out, the algos reacted by more selling. We stopped all the way down at around 280 as support, and now we have a little bit of a reaction by the end of the day. Now, this is typical charting behavior because you have day traders who short in the morning and they cover by the afternoon, by the end of the day. So we see these pops by the end of the day. But look at the RSI. It is becoming extremely oversold. So once again, folks, we're looking for an oversold bounce. That doesn't mean a reversal right away and higher we go. It means we're looking for an oversold bounce. This bounce can take us all the way in a retest to 284. And if the chart gets rejected right away and starts to move down again, then you know that the selling is over. And this is what the bears are looking for. They're looking for oversold bounces to repair the conditions in the RSI. And down we go again. The bears don't want to see severe oversold reactions, especially on the daily chart, because if that happens, that means that we're going to see short covering rallies happening fast. And by that time, a lot of bears would have missed the trade to the downside. Here's the daily chart for the continuous contract for the Qs. For now, we're not even remotely oversold on the daily. So again, we're looking for an oversold bounce on the 30. That could last for a morning, for a day, and then it's going to fade away again because look at the Qs. The continuous contract lost support. We do have a reversal here. It lost 11,689, and now we're looking back at the June bottom of 11,058.5. The volume moved higher on more selling. The RSI is in negative divergence right now, and the MACD is showing confirmation that we do have a reversal here. And we have bearish momentum coming. What about the IWM, the Russell 2000, 30 minutes chart? You can see right on in the morning there was a retest of 183 as resistance. The chart could not make it above this line. It got rejected again. And we got a flush down all the way to the gap support. And now the chart is severely oversold from the 30 minutes perspective. So once again, we're looking for an oversold reaction. We're looking for a bounce, but this bounce is not going to last without any support from the fundamental side. Without support from the PPI, without support from the CPI, without support from the Fed. The Fed is in a blackout period right now, but the bulls need some support to sustain the oversold bounce. Otherwise, it's going to fade right away. Here's the Dixie, the dollar index, daily chart. And again, this is bound to happen. We have a rebound. We look at the RSI. We look at the MACD indicators. We're looking for a reversal here. We're looking for a pop higher in the Dixie. It is just a matter of time before we see the MACD showing green impressions in the histogram, indicating a reversal, indicating bullish momentum to come. It is just a matter of time before we see the RSI reversing the negative divergence. Now think about it. What would be the catalyst for the Dixie to move higher again? If the Fed is not talking, could it be a negative surprise by the PPI? Could it be a negative reaction by a foreign currency right now? Be it the Japanese yen, be it the British pound, be it the Australian dollar, be it anything. It's either or. But there is a pop coming in the dollar. And this is not going to be good news for the companies that caught a massive rebound rally as the dollar was going down. We're talking about Netflix. We're talking about Microsoft. We covered all of these earnings, folks. We look at two companies such as Microsoft and Netflix. Both companies benefit when the dollar goes down because they have a lot of revenue from overseas. Well, if the dollar is going to pop higher again, it's not going to be good news for Netflix and Microsoft, among many other names, including Boeing, by the way. I'm just floating some names for you here. I'm giving you some ideas. If the dollar pops higher, you're going to see Netflix down, Microsoft down, Boeing down, and many other names. And once again, when we dig in and we use the 30 minutes chart for the Dixie, look at this. We have a saucer bottoming formation, and we have a bull flag formation right now, indicating that the dollar is going to move higher. You look at gold, we still don't have a confirmation for that. And we're talking about if gold breaks 1,763 as support. If that happens, this will give the green light for the dollar to pop higher again. Now, what about UK oil, Brent oil, a weekly chart? Folks, I know we have a lot of oil bulls here who are going to be mad at me, but how long can we just put a lipstick on a pig here? Look at the RSI in negative divergence. Look at the MACD starting to break away and move to the downside again. We could see acceleration of the selling here if oil bulls start to capitulate. I know the week is still young. We have 3 days to come, but what more do you need to see? I'm not saying I'm out of the oil trade right now. I'm saying I'm hedged, but I would not recommend for anybody to buy the dip right now without further evidence that we have a bottom and we have strong support in oil. And that could happen from a fundamental catalyst such as a reaction by Russia. But absent of that, down it goes. Now, am I ready to say, hey, go ahead and short oil? I'm not ready to say that. I need to see a little more, just a little bit. But remember, brass balls. Brass balls paid off in shorting the SPX right at the resistance. And the brass balls strategy could pay off shorting oil at the break of 85 as support. To each his own. Now, how bad can it get if oil goes down from this point on? We use the Fibonacci retracement levels and we can find that 77 is support. That's number one. But if that's broken, and in all likelihood it's going to be broken if we see a lot of capitulation here, and if that happens, we have support. The next support will be 62.5, almost. Now, the vast majority of oil companies, and that includes their stocks, are still going to be profitable if oil trades above 60. But the question is, are they going to perform the same way they're performing or they were performing this year? They almost performed as growth stocks. I don't think that will happen, but they will continue to be outperformers because if oil trades above 60, all of these companies will remain profitable. Now, here's a daily chart for the 10-year yield. It is holding at 3.5 as support. Is it going to break this support? Today we saw some weakness in the 10-year and we're still seeing negative divergences in both the RSI and the MACD indicators. Unlike the dollar, we're not seeing a lot of positivity here. But mind you, I'm going to talk about this a little more by the end of the segment. If the 10-year breaks 3.5 as support, it's not going to be because of the good reasons. It's not going to be because the Fed is going to loosen the policy or inflation is going down. If the 10-year breaks 3.5, it's going to be for the wrong reasons, meaning the recession force. That would be a confirmation that the recession force is here. And by the way, we can use this as a confirmation to short oil. Because if the 10-year is reacting in fear of a recession, you think oil is going to perform in a recession? Of course not. That would be a confirmation that goodbye oil, goodbye everything, and hello recession. Here's the TLT daily chart. It is stalling right now. It is becoming a little overbought. We could see a pullback, a little bit of a retracement, but if we look at the weekly charts, the momentum in the TLT remains positive. So the pullbacks for now are opportunities to buy, and the TLT is going to outperform as we head into a recession. The VIX 4 hours chart, it is facing a little bit of a resistance right now, but the momentum remains positive. Look at the MACD, look at the RSI. It is not out of the ordinary if we see the VIX pulling back here, along with an oversold bounce in the SPY. But when we look at the daily chart for the VIX, look at this. 20 is an important point, both as support and resistance. And now it is acting as support again. You look at the MACD. After all of this negative momentum, which lasted all the way since October, looking at the MACD, all of this energy is going to be produced in a massive pop in the VIX, looking at the daily chart. So again, in the short run, we're looking for an oversold bounce in the SPY and a little pullback in the VIX. But in the longer run, the VIX is ready to go, which is yet another confirmation that we're done with the bear market rally. Apple, 30 minutes chart. Look at this. We have the rejection and the confirmation now that Apple is not going to make it above 150. They kept pumping, and they keep getting hit in the head over and over and over again. At some point, they're going to give it up. Apple is not going to make it above 150 again. It needs a piece of evidence. And that could be from earnings. That could be from a piece of fundamental news. It doesn't matter. But Apple cannot pass above 150 without a piece of evidence that says, hey, I earned going back above 150. But for now, looking at the 30 minutes chart, what do we see here? We see oversold reactions in the RSI and the MACD. In other words, we could see an oversold bounce. And the first resistance right away will be 143.56. After that, it's going to be another retest at 145. I doubt that Apple is going to make it above 145. And again, we're looking for an oversold bounce and then another rejection and a reversal. That would be a sign to double down on the shorts. Now, that could happen from 143.56. It could happen from 145. It doesn't matter. Tesla, 30 minutes chart. What do we see here? We got a pop higher in the morning and a retest at 183.80, and immediately the chart got rejected and flushed down all the way to the 177-ish, 176, and now it's consolidating in a bear flag pattern. Sooner or later, despite all of the oversold bounces to come, Tesla will go down to closing the gap that you see from the saucer bottom formation. And I believe that gap stands at 169, almost 170. What about Bitcoin? Still waiting and waiting for this bull flag to play out. But we're running out of time. If it doesn't play out in time, and we mean by the end of this week, guess what's going to happen? The sellers are going to show up and dump this chart down. Time is really important. In any chart, if the chart consolidates in a pattern for long enough, let's say a bull flag pattern, and the buyers don't show up, the sellers are going to show up and we see a failure in the bull flag pattern. So to recap, when we look at the conditions of the end of the bear market rally, I know that Mike Wilson already called it, but to be conservative, to be disciplined here, do we have an SPX rejection and a reversal from the trend? We have a rejection, but we don't have a confirmation for a reversal yet. Do we have a VIX reversal? I think I've seen enough. Looking at the daily chart of the VIX, looking at the MACD, it's going to happen. This is in the bag. Now, when it comes to the 10-year bounce, I have a question mark here because number one, we got a weak reaction by the 10-year today, so we don't have a legitimate bounce yet. Number two, we could see the bear market resuming and the 10-year yield actually going down. And that is because the recession force, because the 10-year is saying, hey, the recession is here. And folks are stampeding and buying bonds looking for safety. In other words, maybe in looking for a 10-year bounce, we're talking about yields here, I'm still stuck in the pre-recession thinking when the market was stuck in the fear of higher inflation. If the 10-year bounces higher, it starts to move higher, the market reacts negatively. But in the recession theme, the opposite happens. The market actually gets excited when we see the 10-year moving higher because folks are dumping bonds, they're not looking for safety anymore, but the market gets jittery and starts to sell off when we see the 10-year getting dumped, as we see more money flowing into bonds out of equities. Does that make sense? This is why I have a question mark on number 3. Number 4, the Dixie, the bounce. We have a bounce. We're just waiting for a confirmation here, from gold at least. When it comes to number 5, that's a check mark. We have a rejection and a reversal from 150. You put 2 and 2 together, we almost have all of the signs that the bear market rally is over and the selling is about to take over again. In other words, a resumption of the bear market. But don't discount the bulls right away because they have 2 catalysts coming. Number 1, the PPI, which realistically should be either flat or slightly down month over month. Number 2, they got the CPI, and that could also be flattish to down month over month. Now, here's the most important point of tonight's show. Let's say the PPI and maybe the CPI come down month over month. Not by a lot, but slightly. Will the reaction by the market be jubilous? A massive rally higher? Then we're stuck in the mentality of, oh, inflation going down, that means the Fed is going to ease and here comes the soft landing. However, and this could be the case, if we see the PPI and the CPI down month over month and the market reacts negatively, then this would be a confirmation that the market now is in the recession mindset, that the market is now finally succumbing to the reality that if inflation goes down, it's going down for the wrong reasons. It's going down because the recession is here. It's not Santa who's coming to town, it's the recession who's coming to town. We'll see what happens, but the reaction is going to be really, really important. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have revisions for the productivity and unit labor costs, and then we have an update for consumer credit. And with that, folks, this is all I got for you for tonight. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
So, you ever show up late?
No.
You have any moving violations?
No.
Do you drink on the job?
No.
You ever hit anybody?
On a job?
Yeah.
No.
Okay.
Do up, diddling, ding, dong, day.